Welcome to class, everyone. Go ahead and get those notebooks out because today we are diving deep into a true explainer masterclass on Chapter 3, Employee Remuneration. We're going to take this step by step, moving at a really deliberate, methodical pace to make sure you capture absolutely every crucial detail for your 2025 BPT exam. This chapter right here, it sits right at the critical intersection of income tax and national insurance contributions. I can practically guarantee it's going to show up on your exam paper. So take a deep breath, get focused, and let's get right into it.
Here is our roadmap for today. We're going to cover 1. Income and employee benefits, 2. The rules for termination payments, 3. Employee share schemes, and 4. Pension schemes and limits. Essentially, we're tracking the complete life cycle of an employee's wealth, starting with those everyday job perks and going all the way to retirement. All right, Section 1, Income and employee benefits. The absolute golden rule you need to keep in mind here is that employment income is taxed on a receipts basis. You get taxed when you actually receive the money or the perk. And for an expense to be deductible, it must be wholly, exclusively, and necessarily incurred in doing your job. That word necessarily is a huge deal. It means the job objectively requires it. No way around it.
Okay, take a really good look at this list of exempt benefits. The examiner loves, and I mean literally loves, testing your ability to separate taxable perks from the tax-free ones. Some are pretty straightforward, like employer pension contributions, workplace nurseries, car parking at work, and job-related accommodation. But you have to watch out for the traps. For example, a subsidized canteen is only exempt if it's available to all staff, not just the directors. Relocation costs? Strict cap at £8,000. And pay super close attention to the fact that it says 1 mobile phone. The limit is exactly 1. If your boss gives you a second phone, even just a basic cheap one, that second phone is a taxable benefit. And don't forget the little things. Incidental personal expenses of £5 in the UK or £10 abroad. Recommended medical treatments up to £500. And non-cash long service awards.
All right, 2.25%. This is the official rate of interest, or ORI, for the 2024 to 2025 tax year. This number is absolutely crucial. You need to memorize it right now. You're going to need this exact percentage for 2 big calculations. First, to figure out the expensive accommodation charge when a property costs over £75,000. And second, to calculate the taxable benefit of a company loan when an employee's outstanding balance goes over the £10,000 de minimis threshold. Seriously, write 2.25% down and draw a big circle around it. Now look at how dramatically the calculation methods change depending on the perk. For expensive accommodation, you take the cost, subtract that £75,000 threshold, and multiply whatever is left by that 2.25% ORI we just talked about. Company cars? You use the list price multiplied by a CO2 emissions percentage. Vans are way easier. They just use a flat rate of £3,960. And what if your employer lets you use an asset, like say a television? The annual benefit is just a flat 20% of its market value when it was first handed over to you. Oh, and one more thing. Please remember that the associated car fuel benefit is a brutal all-or-nothing charge. Literally, 1 penny of employer-paid private fuel triggers the entire massive charge. It's incredibly strict.
Moving right along to Section 2, Rules for Termination Payments. What happens when an employee actually leaves the company? Well, these payments are highly testable because they just have so many overlapping rules.
The key to mastering this is being able to distinguish between the different types of termination payments. First, contractual payments. These are fully taxable, so they get hit with both income tax and regular Class 1 national insurance contributions, or NIC. But discretionary ex gratia payments, those get a really nice £30,000 exemption. You kind of got to be careful, though. If the employee also receives statutory redundancy pay, well, that's exempt, but it eats right into that £30,000 allowance. Finally, any excess over that £30,000 limit is taxable. Actually, underline this next part in your notes. It's a huge deal. The excess attracts Class 1A NIC, and that tax burden falls entirely on the employer. The employee doesn't pay any NIC on that excess whatsoever.
Okay, we absolutely have to talk about PNP. That stands for Post-Employment Notice Pay. This deals with unworked notice periods. And let me be crystal clear, it is completely taxable. You need to write down this exact 3-step sequence. Step 1, calculate the PNP. Step 2, extract and remove that PNP amount from the total termination package. Step 3, only then do you apply the £30,000 exemption to whatever discretionary balance is left. Listen to me on this one. Applying the £30,000 exemption before extracting the fully taxable PNP is the #1 sequencing trap examiners will throw at you. Don't fall for it.
All right, let's jump straight into Module 3, Employee Share Schemes.
This is all about how employees can actually own a piece of the company, bridging that gap between just working there and having real equity.
There's just a massive difference between tax-advantaged and non-tax-advantaged share schemes. Sure, the employer generously gets a corporate tax deduction for both types, but the tax-advantaged options are an absolute game changer for the employee. We're talking no income tax or NIC when they exercise the option. They get access to business asset disposal relief, which means much lower capital gains tax rates. And honestly, they enjoy a massive cash flow advantage simply because the tax is entirely deferred until they actually sell the shares.
You're going to want to study this comparison matrix really carefully to keep the four tax-advantaged schemes straight. So CSOP and EMI, those are targeted at hand-picked key staff. But SAIE and SIP, those must be open to all employees. Look at the maximum values too. CSOP lets you do up to £60,000, while EMI is super generous, allowing up to £250,000. For the all-employees schemes, SAI limits you to £500 a month, and SIP has very specific annual limits of $3,600 for free shares plus $1,800 for partnership shares. Now, what about discounts? Well, EMI allows them, but they are taxable. SAIE allows up to a 20% discount. CSOP and SIP don't allow discounts at all. Finally, look at the company limits. Only EMI has strict rules on the size of the corporation, capping it at £30 million in gross assets. If you understand these structural differences, you'll easily spot which scheme fits the exact scenario they give you on the exam.
Now, the Share Incentive Plan, or SIP, has its very own unique set of holding rules. If an employee gets impatient and pulls their shares out of the trust in under 3 years, they get hit with full income tax and NIC. Between 3 and 5 years, there's kind of this protective buffer, where they're taxed on whichever is lower, the grant value or their withdrawal value. But the ultimate goal is getting over that 5-year mark. If they hold on for over 5 years, those shares can be withdrawn completely free of income tax and NIC. It's basically a massive reward for long-term loyalty.
I really need you to focus on this next distinction. So for standard shares, the 2-year holding period that you need for the 10% business asset disposal rate, that clock starts when you actually acquire the shares. But the Enterprise Management Incentive, or EMI, is uniquely generous. For EMI, that 2-year clock starts ticking the very second the option is granted. That means an employee could technically exercise their option, immediately sell the shares the very next day, and still qualify for that sweet BADR rate as long as 2 years have passed since that initial grant date. It's a huge benefit.
And finally, we've arrived at our last module, Section 4, Pension Schemes and Limits. Let's navigate the heavy compliance rules of pension savings and see how wealth is actually protected for retirement. £60,000. This figure right here is your standard annual allowance for the 2024 to 2025 tax year. It represents the absolute maximum total pension input that can attract tax relief in a single year. And when I say total, I mean both employee and employer contributions combined. If total contributions go even a penny over this £60,000 limit, boom, an excess charge is strictly applied right at the individual's marginal income tax rate.
Now, for high earners, things get a bit more complicated. That £60,000 allowance gets tapered down, but make sure you check both income thresholds before you even think about applying the taper. The individual's threshold income must be over £200,000, and their adjusted income must be over £260,000. It's an and, not an or. Only if both of those are met does the taper kick in, which can drop the allowance down to a minimum of £10,000. You can also carry forward unused allowances for 3 years, but you always use the oldest year first. Oh, and this is absolutely critical for your 2025 exams. The legacy lifetime allowance was officially abolished. Gone. You do still get a 25% tax-free lump sum at retirement, but now it's just hard capped to £268,275. This head-to-head comparison shows you the ultimate exam test when it comes to pensions for business owners. A small self-administered scheme, or SAS, is an occupational scheme that can literally act like a bank for the employer. It can lend up to 50% of its fund back to the sponsoring company on commercial terms. On the flip side, a SIP, which is a personal pension, cannot lend money to anyone under any circumstances. So while they both can buy commercial property, only the SAS has that incredibly powerful corporate lending capability. So what does this all mean when we put it together? I'm going to leave you with this synthesis question to review against your notes. If a director receives an unworked notice termination package and wants to use their SSAS to fund the business, which strict sequencing and lending rules apply? Think really carefully about how you would extract that PNP from the termination package. Apply the NIC rules, and then calculate that maximum 50% lending limit for the SSAS. Mastering exactly how these life cycle rules intersect from termination all the way to corporate pension lending is absolutely your key to conquering Chapter 3. Thank you so much for your focus today, class. Keep at it, and happy studying.